So we're leveraging virtual account management technology from the banks, but we have a ledger system that's built into our core transactional database, and it's leveraging that ledger system to actually maintain the accounts. So how does this all work? So let's say you are CP Widgets Inc. You're opening up a series of MCAs. You open up all of these different currencies or some version of these currencies. You can ultimately then receive both SWIFT wire payments and in-country payments in a number of different currencies. So you can receive those payments, you can push those payments out as well. So you have the flexibility to send an in-country payment for pennies a transaction or a SWIFT wire payment for dollars per transaction, ultimately. You can support outbound payments in 145 currencies, debiting any one of these accounts. So let's say you're holding an Australian dollar account and your Australian subsidiary, maybe it's not even a subsidiary, it's just a division, it's not even a legal entity, but you want to segregate those funds flows. You want it to be separate from your US entity, so you open up a separate bank account. You don't even have a legal entity, but you can have a virtual account, ultimately, that's connected to a division of your US business. You can then initiate payments by debiting funds in that Aussie dollar account to make payments in other jurisdictions around the world, and then it flows through from your accounting perspective, it flows through your reconciliation to the correct division, rather than being run through the parent company, ultimately. So it's a way that you can reconcile and segregate all of your different business flows depending on what you're ultimately trying to achieve. So some of our customers would actually, I don't want to skip too far ahead. So you can also do global collection in 25 currencies. You can convert and pay. So this can be to collect incoming funds. You can net against outbound payment requirements, and you can continue to fund those accounts so that you can make outbound payments in those accounts as well. For all intents and purposes, it operates just like a normal bank account, but it's accessible on just a single platform, ultimately. So let's say you are a Canadian corporate entity, and historically many Canadian companies, so if you're operating in Canada and you're doing business internationally, you probably have your own US dollar bank account. But in all likelihood, you have a US dollar bank account that is domiciled in Canada, ultimately. The key, the key deficiency of that account, if that US dollar account is domiciled in Canada, it's not connected to the ACH network, ultimately. You can't receive ACH payments, you can't make ACH payments. You can only receive international SWIFT wires, ultimately. So if someone pushes a wire to you receive that US dollar payment into your US dollar bank account in Canada, they typically pay a fee of $15 to $35 to initiate that SWIFT wire to you. And when that money comes into your bank account, you will also pay a lifting charge to receive those US dollars. Somewhere between $15 to $20 ultimately that you will pay for each inbound payment.